The Australian Taxation Office processed 14.6 million individual tax returns for the 2023 to 24 financial year. Analysis of that data reveals that approximately 2.8 million retirees either didn't lodge returns at all or lodged returns claiming significantly fewer deductions than they were entitled to. That's not an estimate. That's documented ATO data showing millions of retirees leaving money on the table every single year, money that belongs to them, that they've paid in tax and could legally claim back. For many retirees, we're not talking about small amounts. The difference between a properly optimized tax return and one that claims only basic deductions can easily be $1,500 to $3,000 in refunds. Over a 20-year retirement, that's $30,000 to $60,000 in unclaimed refunds that could have funded holidays, home improvements, or simply provided more financial security. We are on a mission to reach 10,000 subscribers to build a community that is aware of these financial shifts. If that resonates with you, hit subscribe. What I find most concerning about this pattern is that it's not random. Retirees systematically underclaim deductions because many assume that once they stop working, they don't have deductible expenses anymore. They think tax deductions are for employees with work-related expenses, and since they're no longer employed, there's nothing to claim. That assumption costs them thousands of dollars annually. And as we approach June 30th, 2026, which is the end of the current financial year, understanding what you can legitimately claim becomes financially critical. Let me walk you through the major deduction categories that retirees miss most frequently, what the requirements are to claim them, and what documentation you need to have in place before June 30th to maximize your refund when you lodge your return. The first and most commonly missed category involves investment income-related expenses. If you have income from shares, managed funds, rental properties, or interest-bearing accounts, the expenses you incur to earn that income are generally tax-deductible. This includes investment management fees, subscriptions to financial publications or data services, interest on loans used to purchase investments, accounting fees for preparing your tax return, on bank fees on investment accounts. What catches many retirees is that these expenses are deductible even if your actual investment income is modest. You don't need to earn $50,000 in dividends to claim investment expenses. If you earn $3,000 in dividend income and pay $400 in investment platform fees, that $400 is deductible against your total taxable income, not just against the investment income. The ATO requires a clear connection between the expense and earning assessable income, but that connection doesn't require the income to be large. For rental properties specifically, the deductions extend well beyond just the interest on the mortgage. You can claim council rates, water rates, property management fees, maintenance and repairs, insurance, depreciation on plant and equipment within the property, and even travel expenses if you need to visit the property for maintenance or management purposes. Though the ATO scrutinizes travel claims carefully and requires them to be genuinely necessary rather than incidental to personal travel, what retirees often miss is the distinction between repairs, which are immediately deductible, and improvements, which must be depreciated over time. Fixing a broken fence is a repair and fully deductible in the year incurred. Replacing an old fence with a substantially better new one is an improvement and must be depreciated over its effective life. Understanding this distinction matters because it affects whether you get the deduction this year or spread over multiple years. The second major category involves medical expenses, though this is more limited than many retirees realize. The net medical expenses tax offset was abolished for most taxpayers from July 1, 2019, which means you can no longer claim a tax offset for general medical expenses like doctor's appointments, prescriptions, or medical devices. However, there's a critical exception. If you or your spouse were eligible for the offset in the 2018 to 19 tax year because you met the disability or age requirements, you can continue to claim it through transitional arrangements. Additionally, medical expenses can still be deductible in specific circumstances if they're directly related to earning your income. For example, if you have employment income and require medical treatment to continue working, those expenses might be deductible. For most retirees without employment income, this doesn't apply, but for those who continue working part-time or have consulting income, it's worth understanding. What is often overlooked is that private health insurance premiums, while not directly deductible, can affect your tax outcome through the Medicare levy surcharge and the private health insurance rebate. If your income exceeds certain thresholds and you don't have appropriate private health coverage, you pay an additional Medicare levy surcharge of 1% to 1.5% of your income. For a retiree with $95,000 in taxable income without private health insurance, that's a surcharge of up to $1,425. Maintaining appropriate private health coverage avoids this surcharge, and while the premiums aren't a direct deduction, avoiding the surcharge creates equivalent tax savings. The third category is charitable donations. Donations of $2 or more to registered deductible gift recipients are tax-deductible, and many retirees make regular charitable contributions without claiming them. The ATO requires that donations be genuinely gifts, not payments for goods or services. Buying raffle tickets or purchasing items at charity auctions doesn't qualify. Donations to religious institutions qualify only if the organization is a registered DGR, which not all are. What retirees often miss is that donations don't need to be cash. Donations of property, including shares, are deductible at market value if properly documented. If you donate shares worth $5,000 to a registered charity, you can claim a $5,000 deduction, and if the shares had been held for more than 12 months, you also avoid capital gains tax on any unrealized gain. This makes donating appreciated shares significantly more tax-effective than selling them and donating cash. The documentation requirement for donations is specific. For donations under $10, you don't need a receipt, but you need a record of the donation. For donations between $10 and $250, you need a receipt from the organization. For donations over $250, you need a receipt that includes specific information, the organization's name and ABN, the statement that it's a registered DGR, the amount, and the date. Without proper documentation, the ATO can disallow the deduction even if you genuinely made the donation. The fourth category involves tax agent fees and tax preparation costs. If you pay an accountant or tax agent to prepare your tax return, that fee is deductible in the year you pay it. This is one of the most straightforward deductions, and yet many retirees don't claim it. If you pay $350 to have your tax return prepared, that $350 reduces your taxable income at a marginal tax rate of 32.5%, which applies to income between $45,001 and $135,000. That deduction saves you approximately $114 in tax. Interestingly, you can also claim the cost of software or online services used to prepare your tax return yourself, such as subscriptions to tax preparation platforms. The key requirement is that the expense relates to managing your tax affairs, which includes both preparation of returns and general tax planning advice. The fifth category is superannuation-related deductions, which operate differently for retirees than for working-age Australians. If you make personal superannuation contributions and you're eligible, you can claim a tax deduction for those contributions up to the concessional contributions cap, which is $30,000 for the 2025 to 26 financial year for most people. For retirees under age 75 who have relevant income, this can be a valuable tax planning strategy. The process requires you to lodge a notice of intent to claim a deduction with your super fund before the earlier of the day you lodge your tax return for the year, the end of the following financial year, or the day you make a withdrawal from your super. If you made personal super contributions during 2025 to 26 and want to claim them as deductions, you must lodge that notice with your super fund before June 30th, 2026. If you're lodging your tax return early or before the fund processes any benefit payment. What makes this particularly valuable for some retirees is the ability to make contributions during high-income years and claim deductions that reduce tax in those years. If you sold an investment property and realized a significant capital gain, making a deductible super contribution can offset some of that gain, reducing your tax liability while also boosting your super balance. The sixth category involves income protection insurance premiums. If you hold income protection insurance, the premiums are generally tax deductible because the insurance is designed to replace income if you can't work. This applies even in retirement if you have employment income that the insurance is protecting. However, life insurance, total and permanent disability insurance, and trauma insurance premiums are not deductible because they provide lump sum benefits rather than income replacement. If you have income protection insurance through your super fund, The premiums are typically deducted from your super balance and aren't claimed on your personal tax return. But if you hold income protection insurance outside super, those premiums are deductible against your personal income. For a policy costing $1,200 annually, that deduction saves $390 in tax at a 32.5% marginal rate. The seventh category is somewhat unique to retirees with specific circumstances: expenses related to managing or defending assessable income. This can include legal fees incurred to dispute an ATO assessment, costs of objecting to a tax decision, or expenses defending your right to income. These expenses are deductible if they relate to earning your income or defending your income earning position. What's not deductible are legal expenses relating to capital matters or private matters. Legal fees to contest a will or manage an estate aren't deductible. Legal fees to defend against criminal charges aren't deductible, but legal fees to defend your entitlement to rental income from a property dispute might be deductible if structured correctly. There are several other smaller categories that retirees commonly overlook. Bank fees on accounts that earn interest income are deductible, though the ATO disallows deductions for fees on accounts that don't earn assessable income. Interest charged on late tax payments is not deductible, but interest on loans used to purchase income-producing assets generally is deductible. Subscriptions to professional organizations or unions are deductible if you maintain membership to earn income, which can apply to retirees doing part-time or consulting work. Tools and equipment used for income-earning activities can be deducted immediately if they cost under $300 or depreciated if they cost more. Home office expenses can be claimed by retirees who work from home, either through the actual cost method or the revised fixed-rate method introduced by the ATO. The fixed-rate method allows you to claim 67 cents per hour for each hour worked from home, covering energy, internet, phone, and stationery. This method requires a record of hours worked. The actual cost method requires calculation of the proportion of actual expenses attributable to work use, which is more complex, but can result in larger deductions for those with substantial home office setups. What ties all these deductions together is the documentation requirement. The ATO can and does request substantiation of claimed deductions, and without proper records, deductions are disallowed. The general rule is that for expenses under $300 in total work-related expenses, you don't need written evidence, but you need to be able to show how you calculated the claim. For expenses over $300, you need written evidence, such as receipts, invoices, or bank statements. For some categories like car expenses, the ATO has specific methods you must use. For others, like working from home, there are alternative calculation methods, and you can choose the one most beneficial. Understanding which method applies to which category matters, because using the wrong method can result in underclaiming or having claims disallowed. What's particularly important as we approach June 30th, 2026, is that some deductions require action before year-end to be claimable. Charitable donations must be made by June 30th to be claimed in this financial year. Personal super contributions must be received by your fund by June 30th to count toward this year's cap. Investment expenses paid in July won't be deductible in the 2025-26 return, even if they relate to investments held during 2025-26. This creates a strategic opportunity in the final weeks of the financial year. If you're planning to make charitable donations, making them before June 30th rather than in early July shifts the deduction to this year, which could be valuable if your income is higher this year than expected next year. If you're planning personal super contributions and want to claim them as deductions, ensuring they're received by June 30th means you can claim them in this year's return. For investment expenses, if you have discretion about timing, paying in June rather than July brings the deduction forward. However, you can't artificially accelerate expenses that relate to future years. Prepaying 3 years of investment platform fees doesn't make them all deductible this year. The ATO applies prepayment rules that generally limit deductions to expenses for the current year plus up to 12 months forward. What I find most valuable about understanding these deductions isn't just the immediate tax saving, it's the way it changes how you think about expenses in retirement. Many retirees are incredibly cost-conscious, reluctant to pay for financial advice or tax preparation because they see it as an expense. Understanding that those costs are tax-deductible changes the calculus. If tax agent fees cost $350 but save you $114 in tax and help you identify $2,000 in additional legitimate deductions you would have missed, the net benefit is substantial. Similarly, understanding that investment management fees are deductible means the true after-tax cost is lower than the nominal fee. A platform fee of $500 only costs you $337.50 after tax at a 32.5% marginal rate. This doesn't mean fees don't matter, but it means comparing investment options should account for the tax deductibility of fees when making decisions. For retirees with complex financial affairs, investment properties, share portfolios, multiple income streams, the value of professional tax advice compounds over time. A tax agent who identifies $3,000 in legitimate deductions you would have missed year after year for 15 years of retirement has helped you retain $45,000 that would otherwise have gone to the ATO. The cumulative value of proper tax planning throughout retirement is measured in tens of thousands of dollars for many people. What's critical to understand is that the ATO doesn't automatically give you deductions. Tax isn't assessed based on what you should have claimed. It's assessed based on what you actually claim. If you lodge a return claiming no deductions when you legitimately have $5,000 in deductible expenses, the ATO processes your return as lodged and you pay more tax than legally required. There's no mechanism where the ATO reviews your return and suggests deductions you missed. The responsibility sits entirely with you to identify and claim what you're entitled to. This is why the pattern of underclaiming is so persistent. Retirees who don't realize they have deductible expenses lodge returns claiming nothing, pay more tax than necessary, and never discover the mistake because there's no feedback loop informing them of what they missed. The money just stays with the ATO rather than being refunded where it belongs. As June 30th approaches, the action items are specific. Review your expenses for the 2025 to 26 financial year and identify which ones relate to earning income, whether from investments, employment, or other sources. Gather receipts and documentation for those expenses. For charitable donations, ensure you have proper receipts meeting ATO requirements. For super contributions, you want to claim as deductions. Verify they've been received by your fund and lodge the notice of intent if you haven't already. Consider whether any discretionary expenses planned for early in the new financial year could be brought forward to before June 30th. If that timing benefits your tax position, review whether you're eligible for any concessional contribution opportunities that could reduce your tax while boosting your super. Assess whether professional tax advice would be valuable given the complexity of your affairs and the potential deductions you might be missing. What June 30th represents is the hard deadline for this financial year's planning. Actions taken July 1st or later can't be claimed in the 2025 to 26 return. They'll be claimed next year, which may be less valuable if your circumstances change. Understanding what you're entitled to claim, having the documentation to support those claims, and ensuring you don't leave legitimate deductions unclaimed is the difference between paying the ATO more than you legally owe and keeping money that belongs to you. For the millions of retirees who systematically underclaim, that difference is measured in thousands of dollars annually and tens of thousands over a full retirement. The deductions are there. The question is whether you'll claim them before the opportunity closes on June 30th.